it's not the greater use of options that will reiterate or make a decline worse. It is how those options are currently in this environment being used. We have $5 trillion coming in, give or take, and the average amount that moves markets is $150 billion. You probably want to be long before that happens, right? We're in a 75, 80% winning type scenario with this market. But there is a very fat left tail. As we mentioned, if something were to happen, if this market were to decline 20%, watch out. Right as everybody is proclaiming active investment dead, my view is that active investment is actually right on the verge of a new, bull market.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Volatility Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Volatility Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.
In this episode of Excess Returns, we're joined by Cem Karsan of Volatility Advisors for an in-depth look at the state of the global markets and how geopolitical events in the Middle East and Ukraine are impacting risk investors in the broader economy. We also cover a lot of other things like inflation, the Fed's latest move, market flows, options expirations, his outlook for value stocks and the investability of AI, and where he sees markets going for the remainder of the year and beyond. Cem will share his insights on how the current market backdrop compares to other times in history when populism and inflation were elevated and how that impacted returns and investor behavior. As always, thank you for listening. Please enjoy this discussion with Volatility's Cem Karsan.
Cem, great to see you. Thank you very much for coming back on Excess Returns. We appreciate it. Always a pleasure to be here. Always really enjoy these conversations. You know, before we get into all the things we want to talk to you about, we did just want to mention yesterday we crossed and it's still small, it's really not a big deal, but we crossed the 20,000 subscriber mark on YouTube. So amazing. Congratulations. Yeah, thank you very much. And the reason I would just want to mention that to you is, all of the guests that always come on are super generous with the time and the thoughts and wisdom that you share with our audience. And so, it's because of the willingness of people like you to come on, talk to us, and share your opinions, your diverse thoughts on the markets. And so, thank you for always being great and super generous with your time. Jack and I certainly appreciate it, and our audience does too. You say, the truth of the matter is I enjoy this because life is short and we get an opportunity to educate, make a difference, really kind of propel kind of some of these ideas out into the world. And so thanks for giving me a platform. It's wonderful to be involved. It's funny too, like you kind of showed us what was possible. Like when you first came on, you probably had maybe 1,000 subscribers and like our videos were getting a few views here and there, but we released your video and I was like, wow. So this is what we could do. If things work out on YouTube, this could really happen. Oh, that's great to hear. I'm glad I could help. And again, I can't think of a couple better guys to be involved with. So
that's great. Thank you.
So yeah, let's get into it. We have a lot to get through in, this hour here. So I think where we want to start with you is on the Middle East and what's going on there. Just from a market perspective, how do you sort of view situations? Well, that specific one, but do you see it as a major risk to the market? I mean, how do you think through things like this? Yeah. So as usual, I think of the big macro geopolitical things as the weighing machine, right? It's not something that I think people like to think of them as kind of acute short-term market events. And I think they matter to the extent they change the big picture. And so, yes, it matters, but it may not matter to markets in the short term. And we've seen that again and again, right? We've seen geopolitical escalations and things that happen that seem scary and big in terms of geopolitics, but that it may not affect the earnings price of the S&P 500, right? In the short term. But it could have a step effect at some point down the road. It could lead to a higher degree of risk for something that really does matter in the future. And so as it relates specifically to what's happening in the Middle East, the way we've thought about this, and we've been out in front of talking about this for about 4 years now, is that we're entering a period of significant global conflict driven primarily from, by protectionism and the closing of borders, which at its root is because of populism and inequality. And we continue to see a walk down that road, a bifurcation across, major powers. I would put it that Axis, the
number one and number two economy in the world as the biggest drivers of that, the U.S. and China. But it's every country essentially trying to look out for their own interests in the context of seeing a world where not everybody is cooperating. And now we are at a point of competition. And, if you think about that in the broader sense, that started, I think, in 22 with the biggest geopolitical event, which was Russia moving on Ukraine. And at that point, Russia and China announced a joint communique that was oddly not talked about nearly as much as it should have been, which was essentially a joint partnership to counter the West. And that wasn't essentially, I said essentially, it wasn't implicit, it was pretty explicit. And Iran has kind of joined that broad axis. You can call it something like World War III and be bombastic. I don't think you have to. I think the key here is you have certain entities that are trying to counter the power of the U.S. and the West more broadly, and are willing to push back both in economic warfare and in global conflict. And the Middle East, when Hamas attacked, which is by the way an Iranian vessel attacked Israel, that was the beginning of the second front on this war, in my opinion. The timing of that was not a coincidence. If you look back at when they did that, it was literally the day before the pact that was being signed was between Saudi Arabia and Israel for broader cooperation. If you are China, Russia, Iran, the last thing you want is Saudi, right? Who's one of the biggest, obviously, controller of oil prices, being kind of you want to separate them, right, from the West. I'll argue I'm maybe a little biased on this one, but Turkey as well. Turkey is the easternmost member of NATO as it relates to Russia, important military power, economic power in the region. That was also a way of peeling away Turkey from the West in a lot of ways. So both Turkey and Saudi have been much more kind of back and forth between those two sides since that happened, which was a great accomplishment. It's also a way to thin out military for other conflict broadly. So if you're thinking about the U.S. is sending all this money to Ukraine, now they're sending money to Israel and military equipment. You have aircraft carriers in the Middle East, Mediterranean, that are now occupied. These are all things that make the bigger picture and broadly what China is trying to accomplish more possible. So I would put these all as, look at what's happening in the bigger picture. And what does this mean and how does it fit into the broader picture? Our view here is that it's an escalation and continued escalation along a path that we've broadly seen for 4 years and will likely continue. I think the terminus is China moving on Taiwan at some point. Whether that's in a year or in 4, we believe it has more than a 50% chance of happening in the next 4 years. And I think markets are to a great extent whistling by the graveyard on the risks that we continue to see in terms of escalation across the board. So that's how I would think about the Middle East. I would think about it in broad trends and what it says about the continuation of those trends and the reiteration of our viewpoints. But I care about it less in terms of its acute importance in terms of day-to-day trading in the markets and what that means for the next month per se.
Yeah, and I think that's the tough thing for investors is, you go through these things and the market seems to hold up and stocks are doing well. And, you kind of make it through and you have people coming on and say that this isn't going to affect the U.S. economy. But then, you take China and Taiwan. It's like, what is the event that's going to break or be something that really does influence the market? So as investors, we kind of get maybe a little bit, not biased, but, we look at those past experiences and say, oh, we can just push through. And then something else comes up that's bigger than anyone can really imagine. And that will have or could have an effect.
Absolutely. I mean, China moving on Taiwan will have dramatic trading consequences, real economic consequences, which are acute. Think of it as like a COVID type thing, something that is undeniable and will have instantaneous effects on the economies of different countries, supply chains, on major inputs and commodities. So yeah, something like that. I'm not saying geopolitical doesn't matter today or tomorrow, but you have to understand, what events actually have short-term effects and what are just part of a much bigger kind of maybe quilts, or a mosaic of things that are coming together to make the probabilities of that bigger acute issue happening. And I think that's really how we're thinking about this one.
Does the rising use of options exacerbate this? So, if you look at any of the charts about the use of options from 2020 to now, like way more people are using options now. If you do get a big event like China invading Taiwan, I mean, do we get a much bigger decline because of that?
So to be clear, it's not the greater use of options that will reiterate or make a decline worse. It is how those options are currently in this environment being used and where the positioning is at this moment. And to be clear, if that issue happens in 2 years and that positioning is different, then it will have a different effect. The point here is there is massive reflexivity to options and options positionings, right? So if there is a lot of short tail, short vol positioning, at a time when an acute event happens, it will exacerbate it. We've talked a lot about this. I just mentioned COVID, right? COVID started, the decline for COVID in markets started on the day after February OPEX. That wasn't a coincidence. It ended the day after March FLX. That's not a coincidence. It was a V bottom that ended exactly on that day and then came exploring back. Did COVID matter? Was COVID an acute issue? Did it cause supply chains? Did it have dramatic effects? 100%. But to be clear, the move that we had and the speed and timing of that move was 100% exacerbated and magnified as a function of the options and broad convex positioning in the market. We know this going back to 1987, before options were traded, the way they currently are. It's not just a function of what the event is. It's a function of the supply and demand in the markets and those massive convex positioning tied to nonlinear products that is poor and imbalance. It will drive reflexively convex outcomes. And so when that's the case, we see convex outcomes. To be clear, there are avenues and there are times, I apologize, where that positioning is the opposite, where people are very well hedged. Think 2022. I think that's a great example, right? 2022, we had the opposite scenario. People were incredibly well hedged. Why? Because COVID had just happened. Anybody who was short vol got taken out to the cleaners. Anybody who was long vol for that made an incredible amount of money. So survivorship bias, most of the world was very hedged. There was broad understanding that Russia might be moving on Ukraine. This was not a complete black swan. It was more of a gray swan. And so people were very well hedged for it. And what 2022 looked like was a incredibly low vol, tick, and implied vol got decimated into those moves. So as opposed to being a 1 month, 30% decline, what do we get? We get at worst 20% decline that happened over the course of 9 months. And so very different outcome, right? Very low volatility and very different reflexively outcome. And that's how I would characterize it. It's not that options and the increase of options trading is increasing volatility. That's not true. It can both dampen and increase volatility. But positioning tends to be a function of trend, right? So if you have something that's making money again and again and again, what happens? People pile into it, right? And so if you could sell vol and it works and it's also reflexive and drives less volatility, well, people are going to keep selling vol until it breaks. And now when it breaks, then you're going to have a bad outcome. And so, that's just on the sales side. The same happens on the buy side. And so as that positioning gets big, it exacerbates kind of that positioning.
And how do you see people being positioned right now? Like, I would think a lot of people are short vol right now, but maybe I'm wrong. I don't follow behind the scenes. So maybe August 5th or something like that might have washed some of that out. Are people still heavily short vol right now?
So to be clear, how short people are of vol is both a function of how recently a vol event has happened and may cause losses versus not happened. A, and B, it's a function of potential events, potential kind of calendar effects, structured product issuance, a lot of different factors. And right now specifically, because we have election vol, which is very high, we have November and December and January positioning with incredibly high skew because December is the biggest OPEX every year, followed by January and single stocks. And because we have this wobble in August, September that really forced skew and some losses in certain portfolios, we have a lot of poor, convexity, poor positioning on the left tail in equity markets specifically. We're seeing incredibly high skew, on the election on out. I would argue higher than we've seen in other elections, even though the event vol is about in line or maybe even lower. The actual skew or the convexity itself is very, very imbalanced. Dealers are shorted and have raised the price for it because there's been so much hedging in that world. So reflexively, that tends to make the outcomes right distributed, because assuming we don't have a crash, the pricing is quite high. You're likely to have a very positive outcome. But it also does create as you mentioned, if something were to happen, this is a dangerous window. And I would argue that it's not just through January that you'll continue to have some of these issues into early next year, given where skew and longer term positioning is.
Does something like August 5th change positioning a lot? Like on one hand, I would say, wow, there was a major spike that could have washed the people out. But on the other hand, it reversed right away. So did anything really change because of that?
Yes, it did. It did because it's not, people think of positioning in two dimensions. That it was a very big positioning and now it's small, right? That's kind of not how it works. The options are a three-dimensional surface. And there's not just that, they are, nonlinear. And so you can get situations where, like we did in August, where people were incredibly long, short-dated gamma, that they were hedged for the actual realized move that happened. Certain entities made a lot of money on that move because that move happened earlier. If that move had happened in September as opposed to August, this is how kind of specific some of these things are, and how much path is important. If it happened in September, I would argue that decline would have been much more significant, much more dramatic, and an incredibly painful thing for markets. Not a 10% loss, 25% type loss. We would have had a major issue if that decline happened in September. It happened in August. It happened early, and most of the street was very well hedged with pre-September options, and able to hedge the max risk there. The problem is, but what losses did happen is for people that were hedged, but didn't have a kind of extra gamma, there were net short options out there in September, in particular in October, November, December, is that skew exploded, right? And those options that everybody was particularly short relative to everything else went to an extreme. And you had kind of 6 sigma plus moves in vega versus gamma. It's something that you don't really see, particularly on that fast a move. And that caused some really kind of specific losses in certain multi-strategy books and certain, little tranches, right? And the net effect of that was to raise that skew and keep it now much higher than it was. And there is still quite a bit of short exposure out there. Now, people have been managing it and moving it around and, finding ways to get it back at lower cost. And so it's not as acute as maybe, it was. But also, and to be clear, certain entities got washed out, right? And when they got washed out, those people are no longer, have this poor exposure. But I would argue, that was a driver of making now the positioning, as I mentioned, poor. And that poor position can now down the road cause a bigger issue. Again, it has to be the right path. We have to have it happen when other people aren't hedged. Timing matters. And generally that happens with bigger moves in the underlying market. So if you can get a major drive here higher to 6,200 in the S&P, something really high that really gets people off sides that way. And then you kind of drop it, right? Like that causes just a much bigger impact, can make markets a little bit more dangerous from several different perspectives. And again, that's often why those kind of really crazy outcomes happen before a decline. And but again, that positioning is now poor, and it does represent a tail. It's just a matter of how is how the path going to work out, and at what point does that poor positioning in the tail become a problem? If it does at all, maybe at some point there's enough supply and there's enough things, or market's placid enough through December where vol comes down, so we bypass, so the skew kind of settles in. Then we kind of resolve some of that risk in there, and the positioning becomes more balanced. But yes, I would argue what happened in August currently is a driver for some of the major tail exposure that exists out here in the market.
I wanted to shift and talk about macro a little bit. Last time you came on was April 30th for our live stream for charity. And since then, inflation has come down some. The Fed just did their first cut and surprised many people by doing 50 basis points. Like, when you look at the overall macro landscape right now, or what are you seeing?
So I have a big long-term picture, right? I'm thinking 10 years, 15 years. And by the way, we started talking about this 4 years ago. So, this is a big picture thing. And in our estimation, we're broadly going down that path. We have seen no deviation from the bigger picture. Of course, people like to focus on the 3-month, 6-month outcome, the 9-month outcome, right? But inflation is down, right? Like your view, your 15-year view is not coming true. Well, no, that's not how it works. If you think about what we've been saying in terms of inflation is, again, to give the best metaphor for a time period that we can, 1968 to 1982, again, we choose that period because it's the last period that interest rates went up. But during that period, we had 4 periods where inflation came down dramatically, where we went into, we had 2 major recessions during that period. And during the first one, inflation came down from 7 all the way down to 2. So they did come down to 2%, which is the current target, right? So that is not a surprise. That happens because the Federal Reserve is trying to control inflation and they're raising interest rates and they're managing. The key here is structural inflation, secular inflation, which are driven not by the business cycle, but are driven by structural factors within the broader global economy. And they're managing those with cyclical factors. They're managing those with tools that manage the business cycle. So are we slowing down? As an economy, because the Fed took interest rates to 5.5%, and they held it there for a while. Sure, that's been a major driver for how they'd managed to slow the economy. But the slowing of inflation has obviously been very slow, right? It has happened very painfully, very slowly, and it's happened in the context of not only has it happened slowly, but they still haven't reached their target. And we're talking about, recession, right? I would argue where inflation can come down to 1%, and that doesn't change the structural inflationary pressures. The key here is the asymmetry, and I'll highlight what happened 68 to 82 as an example. The asymmetry of the inelasticity of interest rates in these environments. So if you when you start to lower interest rates, and this is what happened in other cycles, in this demand push type economy that we are in, right? It's a demand push economy. What do I mean by that? Because money is going to people, no longer to go into corporations right now. Okay? We're doing fiscal spending. We're sending, we're putting up protectionist measures. We're sending money to people in this type of an environment. And when that happens, and you're in a demand push economy, you have a lot of pent up demand when you raise interest rates. That demand continues to grow, right? And I think about it in terms of real estate, right? People are locked in low interest rates, are stuck in their homes. Just because interest rates went higher, it didn't dramatically slow the economy. What it did is it said, okay, any new demand coming on, it's going to be more expensive for you, right? It's going to be harder for you to drive that kind of demand. But that demand sitting there building. So what happens when you lower interest rates? Now you have all this pent up demand that comes rushing back into the market. Right now, all of a sudden, all these secular inflationary pressures are no longer balanced with the cyclical pressures of higher interest rates. Now they're being stimulated by lower interest rates from a cyclical perspective. And then again, this is what we saw in 68 to 82. And then what we saw then was inflation just picked right back up, right? Because all of this demand came roaring back. And so on top of that, by the way, when the economy slows, it's not just the role that the Federal Reserve is playing by lowering interest rates and releasing pent-up demand. It's also that response is less likely to be just the Federal Reserve, much like we saw in 2020. It's much less likely to be just the Federal Reserve coming in and lowering interest rates. This time around, you're probably going to see more political, right, fiscal policy again. You see more spending to support an economy that's slowing. So if we continue to see fiscal spending, which again is driven by populism and particularly millennial kind of increase in voter demand and voter share, you're going to continue to see more inflation. And again, we think the cyclical effects are asymmetric and inelastic, and that's likely to drive a significant uptick in inflation if we do go into recession. So I expect to see a V-type situation where interest rates come down. And again, we've highlighted this. A steepener is an incredible trade during that time. You don't have to wait. What you'll see is higher interest rates start to happen in the back end of the curve as the front of the curve is coming down. And that's exactly what we've seen. So the best trade has been to be in steepeners. And we believe that'll continue to be the case. Great time to continue to be focused on that type of a trade as well.
Yeah, housing is something I've been thinking a lot about because I could be completely wrong. Like I never thought we'd see rates go up like that and housing go up with it. And now I'm trying to think, am I wrong the other way? Like I'm thinking as rates come down, that's going to, like you said, pent up demand is going to come out. It's going to stimulate housing even more, but it's somehow going to unlock supply. And maybe I've got that wrong too. So I'm not giving you thoughts, but I'm sort of struggling with that.
Yeah, I mean, we were pretty adamant that, real estate's a great place to be broadly, particularly, and real estate's not a monolith, right? Not commercial real estate, but in single family starter homes, household formation and wealth creation is of millennials who are the primary home buyers at this point on the residential side, is up to 45% of where baby boomers were at this age, up from 40%. That's the last 4 years. So dramatic issues in terms of not just wealth inequality, but importantly, generational wealth inequality. The millennials on down have been labor for 40 years in a period where, as we've talked about in the past, in a period where money has been driven to capital. Corporations have been incredibly profitable. They're still at record profit margins because of globalization, because of technological development. And both of those are driven by incredibly low interest rates. So at the end of the day, that's the driving force. The driving force is a generation, actually multiple generations who have, as labor, underperformed and that are saying the system isn't fair and doesn't work for us. A lot of them have been stuck at home with mom and dad, unable to create families and have children. And these are really, and I've seen, by the way, multiple generations in their, particularly on the lower end, their parents underperform, and now they're underperforming their parents. And so that creates that loss of status, that frustration drives political pressure and dramatic political pressure. And the cost of the golden goose that the Fed thought they created, which was low inflation and strong growth, right, was inequality. The reason they could control price was because they weren't sending money to people; they were sending it to the top, and the top doesn't spend. So they created as asset inflation because those people invest, and the more they invest, the more drive for profits there are corporations, which drive globalization primarily, as well as technological development, and that's what we've seen. But we're reversing that, right? At the end of the day, millennials are becoming every 4 years. We don't think about it. 4 years doesn't seem like a lot, but every 4 years, right? A lot of baby boomers are dying off, and a lot more millennials, Gen Z, everybody are moving into political kind of dominance, and that's what's driving policy. And we're repaying the costs of inequality. This is not a new story. I mean, people act like this is a story that doesn't go back 100 years. It's a story that goes back 10,000 years, 20,000 years, right? It's everything, power corrupts absolutely. And the top gets the lion's share of the profits. You could call it survival of fittest if you could argue it goes back 1 billion years. But the reality is, at the end of the day, at some point, there are more people than the top 1%. And at some point there's a let them eat cake moment, and the masses come back, and there's hell to pay. And that's the broad period we are in. Again, I'm not saying it's going to be a revolution, right? But this is when revolution happens and why it happens. And you have to understand the political forces. It's much more predictable than people realize. This is generational. I think the key thing is, and why cycles happen, is people don't realize that inequality isn't just top and bottom. It's generational, right? And the second you realize that labor is youth, tends to be youth, right? And capital tends to be age, then you realize that the changes in these happen generationally. And this is a major driver for cycles. And you could have seen this coming 10 years ago. Now timing it to the year, or what was the thing that set it off? You needed the right to be brought left by the demand from the populism, which is what Trump did right here in the U.S. And we saw others globally do the same. And you had to see, the left was already left, but went even further, right? In the form of Bernie Sanders and AOC. But you needed the whole political spectrum to move left, A, and B, you needed a catalyst. And COVID was that catalyst. In 1965, I believe it was, or 64, I apologize, it was Kennedy's assassination. That's what led to, the catalyst can be any number of things. That led to LBJ being able to pass the Great Society program. But these are all steps, right? They're kind of step functions along. It's people and the world responds to incentive, right? It's pretty simple. It doesn't happen linearly. It happens on path and with all kinds of random things along the way. But you have to be prepared and understand that probabilities are increasing for those things, and that catalyst will eventually come along that will drive a kind of a step function towards those things.
So is it fair to say, given your outlook, that you think the Fed probably made a mistake in cutting rates? I mean, you've talked in your previous appearances about them being in a box here, that it's challenging for them to respond to the cyclical stuff with what's going on secularly. I mean, do you think it was a mistake to cut rates?
It's not a mistake. The Fed doesn't have a choice. The Fed. It's not like by keeping interest rates higher, they're going to create a better outcome, right? They are stuck, much like they had this golden goose. Nothing's free, right? That seemed like they had absolute control and they could do whatever they want whenever, because they were in a deflationary environment. They could just stimulate monetarily every time and not have an inflationary effect, yet still stimulate the economy. That seemed too good to be true. Guess what? It was. It just wasn't too good to be true for that 5-year or 10-year or 15-year period. Eventually it drove enough inequality, enough political imbalance that now you got to pay the piper. At least the extent that we are as a society are decide, right? And when I say we, the voters who are, or those that are have enough control over to in different countries to go for a more to favor median outcomes, to really say, okay, the system is not currently fair, and we want something that is going to be more fair. But as long as that's the political pressure and people are willing to do whatever they need to do to make those people happy, which is what politics is all about, we're going to continue to see that outcome.
So we translate this to markets. One of the things I've learned from your previous appearances is when we have these big up years, there's a lot of flows as we get towards the back end of the year that might lead to the market going up even more. Is that what you're seeing as we head towards the end of this year?
So now we're transferring from the weighing machine, right, the big picture, to the voting machine, right? What happens in supply and demand, and this is what drives the stat. Like, everybody thinks about the weighing machine and the big picture, where we're going, but often looks at the 6-month outcome, or in the case of this last year, markets are up over 20% or 20%, and like are confused because that doesn't fit the big picture, right? That we're talking about, and the issues that everybody's seeing. But that can happen because of very specific supply and demand factors that may have nothing to do with the long-term picture. As it relates to this coming quarter, there are a couple of really big effects. We've talked about seasonality before, and that seasonality comes across when you say that word as some magical construct. Like, it's just, we tend to do well in these periods. But people don't understand the actual supply and demand that drives that. There are two major forces that drive that generally, that are on hyperdrive in a year like this year. And so let's discuss those. Let's start there. What are those two factors? And there's more than two, but these are the biggest ones. One, in any year, companies make money, economy grows, there's embedded inflation, money has to be reinvested, right? And that money, or that collateral, if you will, people call the wealth effect. I don't like calling it the wealth effect, because that makes it seem like this is all just humans going and buying things, and they made more money, so they're going to spend more money. That's actually not what it is. What the wealth effect is if things become more valuable, or there's more money out there, the majority of the world, and I'm talking banks, funds, including the real money, sovereign country, everybody is managing money not based on dollars or notional amount. They're managing it based on risk, on leverage. The whole system is built on leverage. A bank loans money based on leverage, right? A fund invests money in a non-correlated way often, or even in a correlated way based on the amount of risk exposure they have. They get more money, they are going to increase the risk exposure. The real estate market, it's all leverage, right? All the way down. So in a year where the market's up, this is exacerbated because more money is created. So market's up 20%. The basic math is the U.S. market is about $60 trillion. The global market, call it another $60 trillion. That's $120 trillion. Things that are tied to the U.S. equity markets and are valued as a function of them, whether it's private equity or other things, amounts to about another 120. So you're talking somewhere, let's wave our hands at it, $250 trillion of equity-linked assets. $250 trillion. If the market's up 20%, that's $50 trillion of new money, of new collateral. Just imagine your property went up by 20%. Now you have 20% more collateral. Your asset's just worth more. The bank will lend you more money against that collateral. And so the way this works is that money gets reinvested. Now, some of that happens at the end of a day. Some of that happens at the end of a week. Some of that happens at the end of the month. Some at the end of a quarter. Some at the end of the year. Right. So it's not like all of it just gets reinvested year one or day one of the new year. But some very meaningful amount have long lag times, and new funds, new vehicles, new things get started at the beginning of the year. And let's wave our hands at it, but let's say that's 10% of that that $50 trillion. That's $5 trillion of new investment that has to happen in the first couple weeks of the year, right? Some of them had to do it on Jan 1, some get to kind of ease into it, but they better get started, right? $5 trillion. In the context of, I want to be clear, this is the part that most people are not taught about markets. About $100 to $125 billion is the average amount, the average incremental amount that moves markets on a given day. So when you see the market up 2%, by the way, which, based on the math that we just said is about $5 trillion, right? I'm sorry, $5 trillion, yes, of appreciation, right? $150 billion, $125 billion move that $5 trillion. It's like a leveraged venture capital deal where they're releasing 2% of the float, but based on where that 2% trades, the whole market, the whole valuation of that entity is being traded. The whole market is that way, and that's what the world doesn't understand. Is the amount that's moving markets is a very small amount of money, but the amount of what in collateral that increases as a function of that or contracts is dramatic. And this is a big thing that leads to not only momentum in markets one way, but can lead to dramatic liquidity issues on the downside as well. So January 1, if we have $5 trillion coming in, give or take, and the average amount that moves markets is $150 billion, you probably want to be long before that happens, right? So in up years, and by the way, that's why what we call the Santa Claus effect and the January effect, that 4-week period, essentially that month, the last 2 weeks of the year, the first 2 weeks of the year, have an 87% winning rate and an average return of 1.25% per year, which are crazy. Like if you look at 125 years of history and you look at those numbers, it's not a coincidence. This is not Santa Claus, by the way. It's supply and demand. So that's a major, major driver. And again, I get that that's sitting out there December 31st. When do you start planning for that? How do you front run that? But the key is there's an incremental buyer and the world knows it. That's coming into January 1st. Now, if the market declines 20% before then, that comes off the table, right? So very important. So it's kind of a game of chicken as you get closer, right? So very important to watch there. Second thing, which is very important. Again, some of these things seem random, but they're very important. Starting at Thanksgiving in the U.S., going through MLK Day in January, you have more holidays during that 2-month period, right? By far than any other time during the calendar year. And importantly, not just holidays, not actually just days off, but the actual time to volume weighted time during that period is dramatically lower for the days that the market is open. Why? Because Thanksgiving, Christmas, New Year's, this isn't the same thing as Veterans Day, right? Like these are days where people take the whole week off. They go home. They stop managing money markets. They shut down positions. So liquidity goes down, volume goes down, and that 125 billion or so average that moves markets goes down to about 75. So dramatically less volume. And that volume, what we call volume weighted time, which is kind of a term we came up with, is essentially the amount of time that you actually have trading happening, right? It's the amount of actual activity in the markets is 60% of what it is over the rest of the year. 60%. Why does that matter? Why is that positive? Well, it's a couple of reasons. One, because we already talked about how much money is coming on Gen 1, but more importantly, you have all of this skew in the market, these Vana and Trump flows we talked about, the natural buyback in markets. And now markets are less liquid and you have even more acceleration because time is collapsing very quickly. Vol is coming down very quickly. And so you have an acceleration of that buying, and that buying pressure is more impactful each day. On top of that pressure, December and January are the biggest OPEXs of the year every year. December starts out as leaps in the indexes. It's the most heavily traded. All the structured products, everything tend to be tied to the end of the year. Well, that creates more open interest. That drives more Vana and Charm flows. Then it creates more skew, which is a higher price, which means there's more deltas to kind of buy back on top of that. Particularly in a year like this, where it's an election year, we just talked about how skew expanded dramatically, right? In August. Now you have dramatically high skew, massive positioning back there, a bunch of dealer short deltas against it, that assuming, again, big assumption, that we don't decline sometime here between the beginning of those flows really kicking in, is going to kick into hyperdrive in terms of structural positive flows. And again, sitting on the other end of that on January 1st is that reinvestment. So now put those two together. Probabilities aren't very good for this market kind of declining. And if it doesn't decline, and more important to like predicting up or down, the distribution that we're looking at for this market going into the end of the year is incredibly right bias with a left fat tail. Okay. So instead of being a 60% winning probability, we're in a 75, 80% winning type scenario with this market. But there is a very fat left tail. As we mentioned, if something were to happen, if this market were to decline 20%, watch out, right? Like decline 15%. Okay, that becomes a little bit more dangerous, right? 25%, like this thing could, you have a bomb sitting there in the bottom of the market. Now, is that probable? No, it's incredibly improbable. But it's real, and the convexity and the risk to a market in that situation is truly dramatic.
Yeah, this is such interesting stuff to learn as a longer-term investor, because we hear just things like Santa Claus rally, and we don't really have any idea what's going on. It's interesting just to hear what actually is going on behind the scenes. And just before I head it back to Justin, I would really recommend, you did the Keeping It Simple podcast recently with Andy Constant and Mike Green and Harley Bassman, and I would really recommend that, because that's I learned so much about market structure preparing for this, listening to that episode. So I would highly recommend anybody listen to that.
Yeah, great group of guys, wonderful conversation. But yeah, definitely check that out.
It's kind of crazy to think that, we're basically 30 days away from a presidential election here, and we're going to have a new president. And how are you thinking about the impact of the election on the markets?
Yeah. So I got to the more structural effects and how they're bigger this year and all the things, but what we didn't talk about is what's not the same every year, right? And that's the election, particularly the kind of election we're amidst. When I step back and look at where we are in a kind of bigger picture, right? And I talked about that period, 68 to 82, right? Elections are, particularly populist elections like we're talking about, are incredibly positive years. A couple of statistics, I've mentioned these in kind of a couple of the spots, but I just think it's so important and meaningful for people to understand. If you look, you hear all the time about how election years are very positive, right? But if you look at 100 years of history, you go back to 1928, and you look at about 100 years of history, and you take all the elections in the United States since 1928, all of those election years combined are up about 12.5%, 13%. That's pretty positive, right? And they have a win rate of something like 80% or something. Now, what people don't realize is if you take just the elections as follows: 64, 68, 72, 76, 80, right? Those five, right? And you took those five out of the election, out of the data set. The actual return of the S&P 500 in the election years is 5.5%. Now, wow, that's a pretty big difference. So what happened in those 5 election years? By the way, they're just back-to-back elections during, guess what, 68 to 82, that same period we're talking about, which is a populist period, dramatically populist period. What happened in those 5 years? The average return during that period was 21.5%. Every single one of those years was positive double digits. There wasn't not even a single digit year out of those 5. And guess what? If you take the last 2 elections, including this one, we're not done with the year, let's assume we end up where we are right now, which is 20%. The average performance of those was also 21%, right? This is not a coincidence. You have 7 populist elections, periods where there's a massive populist push. You can argue all you want that the pretty clear in terms of spending, all the trends that we're seeing are very similar. Those 7 years, to have those type of positive returns consistently is not only an outlier in a data set, right? It's the consistency is fairly incredible. What makes it even more incredible is if you then go look at the market performance outside of those election years during those periods, dramatically negative. So if you pulled out those 5 years, right, from that 17-year period, 60, let's go back and say 64 to 82, the real returns of the market for that whole period was down 50%. Okay, down 50%, real terms, right? In nominal terms, up slightly positive, right? If you pick those 5 years out, it's a 90% decline in markets over that period, right? So the other years in that 17-year period, take those 5 years out, 12 years, almost every single one was a losing year. And the ones that were losing, there were several dramatic declines, like 35% type years. So it's this really weird juxtaposition, right? You have this broadly very inflationary populist period. Interest rates are broadly secularly increasing. That's very poor for assets. It's a demand push economy. But guess what? On election years, incredibly positive. We're seeing the same thing. We're seeing the exact same thing, right? If you look at what happened in 2020, other than the March kind of issue, right? We had a decent year. 22, we had a really poor year. The market went nowhere until the beginning of this year, literally going back to that year. The market has gone nowhere. In real terms, it's actually down until this year. We're seeing another 21% rally here in the markets. You take from that data what you will. I don't think this is a good time at the end of 2024 after a 20% run in a broadly populist period with all the issues that we've talked about: deglobalization, protectionism, populism, all of the commodity issues were underpinning that we've seen, all the potential risks out there, and not to mention where valuations are, record margins to be looking to get long at the end of this year. That said, you'd be crazy, in my opinion, to not be bullish into the end of this year, assuming we don't get a dramatic sell-off in the next month. And so that's the broad view, and that's the broad context, which I think you need to be thinking about these markets.
And do you think that's just a function of investors thinking that, there's going to be some type of positive change and catalyst, or something better is coming for the country, for the economy, and that's what the market effectively is discounting in those election years?
Part of it, people get told all the good stuff, right? But at the end of the day, in a very contested election, which is by the way, if you go back to all the elections I talked about in the 60s and 70s, by the way, they were all incredibly contested elections. There was only one election out of all those years where the incumbent won, and that was Nixon, and he got kicked out of office. All right, that's not true, by the way. Take that data set out again from all the other data. Incumbents usually get a second term. It's a function of the environment. So in these contested elections, the incumbent is looking to do anything they can in a very at a time where it's almost a liability to be an incumbent, right? Because people want change. they're incentivized to do whatever they can to support the market because they need at least a positive market outcome to try and get reelected. On top of that, it's a populist period. And people, particularly that youth that's coming to the voting age, are looking for some way to correct the lack of fairness and the inequality in the economy. So, yeah, people follow incentives. Guess what? Politicians give a bunch of giveaways and do whatever they can to support markets during those years, and they do it at all costs. But it's borrowing from the future. At the end of the day, they're things that are only going to drive more structural inflation, bigger issues in the broader picture. So yeah, some of it's hope for change, but I think the bigger part is just more spending, more cyclical inflationary, asset and broadly inflationary pressures that come due in terms of the cost of them down the road, but right now are cyclically stimulative.
One of the things we like to ask people, and I know you know Mike Green pretty well, and he has these views on the passive flows impacting the market and stock prices. Do you have any opinions on Mike's thoughts around that?
Yeah, absolutely. Mike and I have talked about this for years. Completely agree with the process and the framework. It very much true. There is a natural momentum factor to passive investing, and that passive investing has grown to such a scale that it is one of the primary drivers of momentum in this market. Now, the part where I kind of differ or disagree is with the idea that, hey, this is inevitable and this will just continue and markets have changed forever. I really think it's a function of, and I'm going to back up here. I think passive investing, as much as it's been sold to the world and the narrative is that passive investing is some new innovation. It is the new way to invest. It's low cost, great. Just set it and forget it. Like easy. Why wouldn't you just set your money away and passively invest? Indexing, to be clear, was introduced about 150 years ago. So this idea of passive investing is not a new idea. The reason it's become popular is because interest rates went from 20% to zero, and we saw a massive boom in equity performance. 60-40 is the easy set it and forget it. Everybody just assumes that's how you invest now. Actually, if you ask your average person, how do you invest? You buy assets for the long term, and you keep buying. That's the viewpoint. Again, 1968 to 82, my period right before passive investing started, there wasn't a lot of passive investing. You know why? Because it didn't work. Because 1968 to 82, you lost 70% of your money in the equity market. If you had any duration over 14 years, not over 1 year, 2 years, 5 years, 10 years, over 14 years, you lost 70% of your money. And in the bond market, you did just as poorly if you had any duration in the portfolio, right? If you had cash, by the way, you probably did as poor. So passive investing didn't happen. What came about during those periods? Hedge funds, right? Value investing, big Warren Buffett, a lot of things that not really talked about as much. Active investing broadly was very popular because it worked. But guess what? That's not what you hear from people now. You hear about passive investing. So tell me what's going to happen if we see a 15-year period where the market net goes nowhere and in real terms loses 70% of its value. If that were to happen, what happens? Well, that's the incentive. If we're right and we think that's what's likely to happen, what happens to passive investing? And my view is that, Mike's view is, and I think it's a defensible view, that like, who knows, let's see, is that the powers that be at Vanguard are so entrenched that and politically connected that all the 401k flows and everything will continue to flow to all these passive vehicles. And it's going to change. I do. I think we'll have maybe passive investing, but maybe more passive investing in active vehicles. That's interesting, right? If those are working, that's what's working. Guess what? People go to what's working. If they go 5 years and they're not making money in the market, but they see an active manager who's making 10-15% a year, guess what? Those things are going to get the assets. And so I think we're right as everybody is proclaiming active investment dead. My view is that active investment is actually right on the verge of a new bull market. And I think personally, people unfortunately will be 10, 15 years from now primarily investing in that, right? When they should be passively investing 60-40 again. It's just the way markets work. So I think, yes, passive flows are a primary driver as we speak. But I think just as we're talking about them and assuming that they will reflexively create more of the same forever, that we are at the cusp of much like everything else in this world, of its imminent demise.
Yeah, I mean, it's from 2000 to 2009 when the S&P 500 went nowhere, very few investors were in the S&P, but yet, people like to look back and say, well, if you would have been in the S&P over the last 25 years, you would have gotten this. But I mean, it was a lost decade there, and everyone was piled into whatever it was. The BRICS value stocks did well during some of that period. So I think that's a very good point to recognize that people pile in, and usually investors on the whole are late. And it's been it's been a great 15, 20-year period for passive, but to your point, maybe a lot of it's been interest rates and other things that have influenced that. So it's good as sort of systematic value investors, particularly Jack, we're holding out hope for the reversion in cheap stocks, right, Jack?
You're giving us a little hope here, Jim. We want some hope.
I think that data set regarding elections is pretty striking. And by the way, I didn't go looking for that data. I had this thought. I was like, I wonder how these election years are. And it's just go look at the data. It's pretty striking. And it's for these specific periods during these specific times. All the political effects are also incredibly in line with what we're seeing. So just if it follows again, and again, this is the moment, right? Yeah, we'll see. We'll see. This is the moment. The next year or two are we going to start seeing with more fiscal stimulus, with more kind of continuation of the broader secular trends we're seeing? Are we going to see an uptick in inflation at some point here? And is the populist impulse going to continue? I'm willing to bet that that's just getting started, and I think that's a function of generational change. It's not a straight line, but I do think that those types of situations mean you're essentially in a regime change, and that's an incredible opportunity for relative value opportunities, systematic investing, lots of other strategies that have not been able to compete with kind of 11, 12% annual equity returns. But again, I don't think it's a coincidence that we're at record profit margins. We're at, all of these metrics similar to like we were in '68, right? As these trends are changing.
Just two more quick questions here before we wrap it up. The first one about AI. So I just saw that OpenAI got, I don't know, it was something like $160 billion valuation. They just closed like a $6.5 billion round. But just, do you have any thoughts on AI from like a productivity perspective and then also an investment perspective? Have you given any thought to those two?
Oh, how can you not, right?
Right.
Actually, I haven't thought about it. I've just had my chat GPT thinking about it for the last couple of minutes. But no, look, it's important. Right? I'm not going to sit here and say, big structural changes and technological development don't drive major long-term deflation and growth broadly. That said, I do think it's important to remember that a primary driver for technological development is cheap money, is the ability to invest in things that are not yet profitable, deal with all of the new, before all the network effects come into line and the regulation and all the input costs, everything gets sorted out. There's a period of low profitability for generally these things. And it takes a lot of investment, right? And investment comes from cheap money, right? We've been amidst a technological boom. You could argue not just since 1995 when Greenspan lowered the natural state of interest rates, but really since the 1980s and the supply side push by Reagan and by the Federal Reserve at that time as well. So doesn't mean we've had, by the way, since the invention of the wheel, right? Incredible. They don't seem as big now, right? Because this just seems like, this is big. When you're at the edge of the curve, it just seems like everything is just bigger and bigger. But relative to the time, every innovation that's come before us has been a dramatic innovation, and change how fast and how quick the world is changing, and push this growth. But it doesn't go in a straight line. And the investment in this new technology and the speed at which it's accelerated is very much tied to money being available. I would argue that Amazon, Uber, Tesla, go down the line, all these companies, which for the majority of them didn't make money for 20 years, right, would never have existed. The technologies that we now rely on and are used to saying, okay, this is a day-to-day part of our lives, would not have been around if the money had not been cheap, right? So AI is a culmination of that, right? We've been working on artificial intelligence. You've heard about artificial intelligence, at least I have, for about 30, 40 years. It's not new. But the investment, the 0% interest rates drove enough of a boom in Silicon Valley and across the world to generate kind of enough investment to really make huge progress in these things. What happens when the tide goes out? We're actually starting to see it a bit, right? Not in AI specifically, but broadly in tech. And I would argue if we have an economic slowdown, interest rates do continue to go higher, we're going to continue to have harder and harder times for the growth industries and good old industries like, manufacturing, et cetera, which are kind of boring, are actually going to do better because they get cash flows today. And those are the entities that are ultimately going to have the money to purchase and fund growth and other technologies. But the point is, likely to get interest rate continue to increase, a slowdown, and does happen overnight in technological development and tech, which has been at the core of everything that's worked, right? Globalization and tech, right? If you bet on those things for the last 35, 40 years, you're an incredibly wealthy person, period. If those things are slowing down, right, with a higher cost of money and populism, I think it's going to be slower than people expect. That's my view. I think the exuberance is overdone. It doesn't mean that we're not going to continue to evolve, and AI is not going to continue to be very important to kind of how the world works. But guess what? To your point, it's going to reduce costs and it's going to change. There are, in a populist period, do you think labor wants AI to the extent that we're talking about its development? Do you think government is going to not put regulation around AI? There's all kinds of examples already happening where labor unions are demanding certain restrictions to AI, right, as a function of regulation. So not to mention, we're starting to hear about, there's a lot of energy that needs to go into a lot of this. We also have issues related to microprocessors. Is there enough? What if there is a war in Taiwan, right? Like, all of these things are things that people are just kind of whistling by because the hope and the view on AI is just seen as just world changing today, tomorrow. And yes, it's important, much like the internet was important. By the way, in 2000, obviously the valuations aren't where they are. We're not there right now. But in 2000, the world was right. The internet was the most important thing that could possibly happen. Right? Didn't stop 97% of internet companies going bankrupt. It didn't stop the NASDAQ from dropping 91%. Right. So I just think it's important to take these things with, in a measured way, and to look at the bigger picture and understand that the only thing driving the growth of these industries is not just the idea. It's not just the growth and how this is going to change the world. It needs picks and shovels. It needs inputs. It needs regulation. It needs all of these things. And we're at a point where that's been going for 30, 40 years. And in my opinion, that's in the process of slowing down. And that's going to be very hard for growth industries, AI being at the tip of the spear. So I would be very, again, bullish of AI long-term. Hard to say who the winners are going to be. Hard to say. I don't think it's going to be as quick as people expect. And I think there's going to be a lot of bumps along the road. So I would be very cautious with given some of the valuations.
Oh, Jem, we have a new standard closing question. I think you're one of the first people we're going to ask this to. So the question is, what is the one thing you believe about investing the majority of your peers would disagree with you with?
Options are not a derivative. They are the underlying. When people refer to options and all the volume increases and wow, the phrase that everybody uses, it's wow, the tail is starting to wag the dog. I'm here to tell you that options are the dog. What do I mean by that? Well, pretty simple. If you look at a stock or a bond or any asset, right? People, it's two dimensions. It either goes up or down. What if I gave you two stocks, white label, no name on it, same market cap, same industry, same everything? You would say, well, those are the same stock. What if I peel back that option train and show you that one is incredibly right distributed with a left tail, the time which that distribution is completely different and the growth trajectories are different. Whereas on the other one, it's the exact opposite, very much a value stock, maybe left distributed, right fat tail in case they come up with a solution, completely different stocks. The actual options are giving you nodes and probability across the full distribution of what this thing looks like. At the end of the day, that asset, whether it's a stock or a bond, has a full three-dimensional picture of its characteristics of what the asset is. The asset itself is the thing, not the stock price, not the asset value. The asset value is just a summary of that full distribution. By arbitrage, every node on that distribution that represents this asset is summarized by one price, which is the asset price, the stock value, the bond value. Everybody started in that asset value, that very simple two-dimensional world. And derivatives are new, so we call them derivatives because they're derived from this thing. But the reality is they're not a derivation. It's a better technology. It's a better way to we're going from a two-dimensional sheet to a hologram. You're seeing the whole thing in its full essence. And the reason it hasn't been used more until more recently, but again, we've seen secular growth since I've been in the business for 25 years, and it's been exponential. But the reason is because of network effects. Much like a technology, even if it's a better idea, you need to build infrastructure and you need more volume and you need more participants for it to be an active and to become the core thing that everybody uses. What have we had in the last 25 years since I started in the business? We went, when I started in 1998, we had one quarterly expiration in the S&P 500, and options were priced at every 3 to 5% in the market. That's it. Now we have every day. And by the way, the multipliers were 250. We have every day expiration. We have every 5 points in the S&P. We have options for every single major equity and every single asset across the world. We have more education. We have access through brokerage and regulation has thinned out to allow much more access. Not to mention we've gone from 250 multiplier to 100 to 50 to 10 to 1 to now 0.1. It is incredibly available now, and people are beginning to get educated, understand. But the reality is we're still at the tip of the iceberg. It is a superior way to position based on information that you have on any asset. You can express any point without taking the full risk of the whole asset at any point in time or moneyness on that asset. And that is just a superior way to express information. So my view is that the world is going to options, and that options will be the primary way to invest in the future. And whereas even though notionally there's more trading volume, and realistically it's still 1% of total investment that happens in the market. And my belief is that if you look forward in 20 years, 40 years even, we will be in a completely different world where options sit at the core of investing. So that would be my one different view. I think that, again, probably biased as a function of my where I come from and what I see. But that's my one thing that I think most people would disagree with.
Thank you, Jem. Always a class act. Really appreciate it. We hope to have you on again.
Wonderful being here. Thanks for having me. Look forward to the next one.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.